Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're starting with some significant news regarding the Canadian 10-year government bond yield, which has recently dropped to a 4-month low. This development has sparked quite a bit of conversation in the financial and real estate sectors.
That's right, Sandy. The yield fell below 3.3% in September. The markets are increasingly pricing in multiple rate cuts this year from major North American central banks, which is a pretty big deal.
Exactly, Steve. Softer headline inflation and signs of moderating growth are shifting expectations. Many now believe that the Bank of Canada might begin easing sooner rather than later. But of course, they still need to keep an eye on persistent price pressures.
Yes, and let's not forget that Canada's August Consumer Price Index rose by 1.9% year-on-year. This keeps the headline inflation below the Bank of Canada's 2% midpoint. So, there's some room to maneuver here, but they have to be cautious.
Absolutely, Steve. The monthly consumer price index prints and the cooling demand have really pared back that inflation risk premium, which is usually embedded in long-dated yields. It's interesting to see how these dynamics play out.
And while core measures remain firm, they're flattening, which lowers the term premium investors' demand for duration risk. It's quite a balancing act for investors and policymakers alike.
That's a great point, Steve. At the same time, we've seen United States Treasury yields trading near 5-month lows as markets reassess the Federal Reserve's path ahead of its policy meeting. This global decline in long yields has certainly helped pull Canadian rates down.
It really shows the interconnectedness of global markets, doesn't it? What happens in the United States can significantly impact us here in Canada, especially in terms of bond yields and rate expectations.
Definitely. All these elements work together to influence the real estate market as well as the broader economic landscape, so it's crucial for our listeners to stay informed about these changes. Let's move on to the Bank of Canada's anticipated rate cut tomorrow. The economic slowdown seems to be taking center stage over inflation concerns.
That's right, Sandy. The headline inflation did rise by 1.9% in August from a year earlier, but that's still below what economists were expecting. The Bank of Canada seems more focused on the broader economic backdrop, which is showing signs of slowing down.
And this comes despite the core inflation measures remaining somewhat elevated. The CPI trim edged down slightly, and the CPI median held steady. So while inflation isn't completely off the table, it's not the main concern for the bank right now.
Exactly. Economists like Andrew Hensich from TD Economics have pointed out that there's momentum in the right direction, especially with the smaller than expected impact from higher energy prices. It's a complex situation, but the bank seems to have room to maneuver.
And BMO's chief economist, Douglas Porter, described this situation as a low-drama affair, noting that the inflation measures rose only modestly in seasonally adjusted terms. It seems like the market has already priced in a rate cut, but future moves are still up in the air.
That's a good point, Sandy. Derek Holt from Scotiabank suggested that the bank's decision-making is already well advanced, focusing more on forward-looking risks than on 1 month's data. It's all about weighing those broader economic trends and potential risks.
And with rising unemployment and job losses, there's definitely room for the bank to consider a rate cut. Some economists even expect another cut in October, pointing to economic slack and the potential for weaker prices.
Yes, Andrew Grantham from CIBC is forecasting that additional cut next month. He highlighted the economic slack and the cooling core inflation as reasons for further relief. It's a cautious approach, but it seems warranted given the circumstances.
The bond markets seem to be taking this in stride, with 5-year Government of Canada yields only slightly fluctuating after the release. It shows that investors are adjusting their expectations accordingly.
Absolutely, Sandy. It's all about managing expectations and understanding the interconnected nature of these economic indicators. The Bank of Canada has a lot to consider, but it seems like they're prepared to take measured steps.
The Canada Mortgage and Housing Corporation has reported a significant decline in the annual pace of housing starts for August, dropping 16% compared to July. The seasonally adjusted annual rate now sits at 245,791 units, down from 293,537 units the previous month. This is a notable change that has caught the attention of many in the real estate industry.
Absolutely, Sandy. What's particularly interesting is that Canadian centers with populations of 10,000 or more saw their annual pace of housing starts fall to 223,728 in August, from 272,330 in July. This indicates a broader slowdown that might be affecting urban areas more significantly.
Yes, and even though the annual rate of rural starts was estimated at 22,063 in August, the overall trend shows a decline. It's a reminder of how interconnected these markets are and how changes in urban areas can ripple out to affect rural regions as well.
That's true, Sandy, but there's a bit of a silver lining here. The 6-month moving average of the overall seasonally adjusted annual rate actually rose by 1.6% in August to 267,259 units. This suggests that while there's a short-term dip, the longer-term trend might not be as dire.
Good point, Steve. According to the Canada Mortgage and Housing Corporation, actual housing starts in August for centers with populations of 10,000 or more totaled 18,408, which is an increase from 16,775 in August of last year. So, while the month-to-month numbers are down, there's still some year-over-year growth.
It's always important to look at the bigger picture. The year-over-year increase in actual housing starts suggests that there might be underlying strength in the market that isn't immediately visible in the monthly data. This could point to resilience in the housing sector despite recent fluctuations.
Absolutely, Steve. It's crucial for those in the real estate industry to keep an eye on these trends, as they can inform investment decisions and strategy. Understanding both the short-term and long-term dynamics is key to navigating the market effectively. Chris Wilson-Smith recently highlighted an uneven housing outlook across Canada. While some areas are experiencing growth, others are facing stagnation or even decline. This disparity can be attributed to a variety of factors, including regional economic conditions, differing levels of demand, and varying local government policies.
That's right, Sandy. The report pointed out that cities like Toronto and Vancouver are seeing a resurgence in home sales, likely driven by a combination of pent-up demand and the easing of pandemic restrictions. These cities are benefiting from strong economic fundamentals and a renewed interest in urban living.
Absolutely, Steve. But it's a different story in other parts of the country. For example, some regions in the prairies and Atlantic Canada are experiencing less robust growth. This could be due to slower economic recovery in those areas and a lack of significant population influx, which often drives housing demand.
The report also mentioned the impact of rising interest rates on the housing market. While some buyers are rushing to lock in mortgages before rates climb higher, others are being priced out of the market entirely. It's a complex situation, and it's affecting regions differently depending on their local economic conditions.
And then there's the issue of housing supply. In many of the high-demand areas, there's still a shortage of available homes, which is driving prices up. Meanwhile, in some of the slower markets, there's an oversupply, leading to stagnant or even falling prices.
Exactly, Sandy. The uneven distribution of housing supply and demand is a significant challenge for policymakers. They need to balance stimulating growth in slower areas while managing overheating in the hotter markets. It's a delicate balancing act that requires careful planning and coordination.
And let's not forget the role of government policies, which can heavily influence these trends. Different regions have different approaches to things like development regulations and housing incentives, which can either encourage or stymie growth.
Yeah, and while some policies are aimed at cooling down overheated markets, they can inadvertently affect regions that are already struggling. It's crucial for policymakers to consider the broader impacts of their decisions and strive for a balanced approach.
In today's real estate news, Ontario's real estate regulator has taken legal action against former executives at iPro Realty over allegations of trust fund theft. This is a serious development that could have wide-reaching implications for the industry.
That's right, Sandy. The Real Estate Council of Ontario, or RECO, has filed court papers seeking to recover consumer deposits and agent commissions that were allegedly misused by iPro's former leadership. They've described this as a trust scheme, which suggests a deliberate and systematic misuse of funds.
According to RECO, these funds were supposed to be held securely in trust accounts. These accounts are crucial in real estate transactions as they hold buyer deposits and agent commissions until a sale is finalized. The misuse of these funds is a significant breach of trust.
Absolutely, Sandy. RECO is asking the Ontario Superior Court of Justice to freeze assets and trace the diverted funds. They're also cooperating with law enforcement and have ordered a forensic audit of iPro. This shows the seriousness of the allegations and the lengths the regulator is going to ensure accountability.
Katie Steinfeld, the chair of RECO's board of directors, emphasized that consumers and agents placed their trust in iPro and that trust was violated. It's a stark reminder of the importance of maintaining integrity in handling funds in the real estate sector.
Brenda Buchanan, the CEO of RECO, also described the situation as a serious breach of trust by iPro's former leadership. This highlights the need for stringent oversight in the industry to prevent such incidents from occurring.
Interestingly, the Ontario Real Estate Association and the Toronto Regional Real Estate Board have issued a joint statement supporting the legal action. However, they've also called for more measures, such as independent oversight of RECO through the Ontario Ombudsman.
Yes, they've noted that this issue has impacted 2,400 realtors and their clients across the province. It's clear that the fallout from this alleged scheme is quite extensive and underscores the need for robust regulatory frameworks to protect stakeholders in the real estate market.
It's crucial for everyone involved in real estate transactions to understand how trust accounts should be managed and the legal requirements surrounding them. This case serves as a cautionary tale for the industry.
Definitely, Sandy. This situation illustrates the potential risks when trust is breached and the importance of transparency and accountability in real estate dealings. It's a reminder for all stakeholders to remain vigilant and adhere to industry regulations.
Let's turn to the recent Canadian Consumer Price Index data for August 2025. Inflation accelerated less than economists expected, coming in at 1.9%, which is up from July's 1.7%. This report is pivotal as it sets the stage for the Bank of Canada's interest rate decision.
That's right, Sandy. While the headline inflation rate did tick up, it's important to note that underlying price pressures actually eased. This gives the central bank some leeway to consider cutting interest rates, particularly as they're grappling with the impact of tariffs and a cooling economy.
The data showed that gasoline prices played a significant role in the slight acceleration of the Consumer Price Index. But when you exclude gasoline, the index actually slowed to 2.4% from 2.5% over the previous 3 months. This highlights how volatile energy prices can influence the overall inflation picture.
Absolutely, Sandy. On a monthly basis, the Consumer Price Index fell by 0.1%, whereas economists were expecting it to remain flat. This unexpected decline adds to the argument for the Bank of Canada to cut rates, especially since recent labor data shows significant employment losses and a rising jobless rate.
Indeed, Steve. The recent labor reports indicated employment losses exceeding 100,000 positions in July and August, with the unemployment rate climbing to 7.1%. This economic backdrop, coupled with a 1.6% annualized contraction in the second quarter's gross domestic product, underscores the challenges facing the economy.
And traders are already responding, with overnight swaps fully pricing in a 25 basis point rate cut. The 2-year government bond yield has dipped slightly, and the Canadian dollar is trading at $1.3759 per US dollar. These market movements reflect the anticipation of a rate cut.
Economists like Andrew Grantham from CIBC are expecting not just a rate cut tomorrow, but also another one in October. He points to the economic slack and the removal of tariffs as factors that could further cool core inflation in the coming months.
On the other hand, Benjamin Reitzes from the Bank of Montreal suggests that while the breadth of inflation has improved slightly, it doesn't signal an all clear. Core inflation remains at 3%, and the Bank of Canada will need more evidence of slowing growth and inflation for future rate cuts.
Stuart Paul from Bloomberg Economics also weighed in, emphasizing that the Bank of Canada is likely more concerned with downside growth risks than the recent inflation uptick. The combination of weak labor markets and a surprise decline in gross domestic product strengthens the case for rate cuts.
And Stephen Brown from Capital Economics noted that the central bank's preferred core measures might overstate inflation. And with the 3-month annualized rate holding steady, the bank might see core inflation as less of a threat than before. This supports the likelihood of a rate cut tomorrow.
Overall, it seems the consensus is leaning towards a rate cut, given the current economic conditions. It's a delicate balance for the Bank of Canada as they navigate these complex dynamics.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals.